Okay, well, we have to discuss the a very important concept, and that is called monetary policy. In this lecture, we'll discuss monetary policy. The first thing we will discuss is about the definition, that what is the definition of monetary policy. Then we will discuss the history from the from the uh, from the ancient civilization to the modern concept about the monetary policy, and then we will discuss some tools that are used to achieve the monetary policy objective, which the objective which we will take from the definition, that what is the objective of the monetary policy. And then we have four tools that we will use to achieve the monetary policy objective. The first one is setting the interest rate. Then we will discuss about the open market operation. Then we will discuss reserve requirement and discount window lending, which affect or which are used for the achieving the monetary policy objective. Then at the number four, we will discuss the types of policies, the two main types of monetary policy, which is expansionary monetary policy and contractionary monetary policy. And at the last, we will also discuss that which type of policy is usually adopted by the politician during before, when in the late of the election. So when the election is near, then what type of policy they are usually adopt. So let me take you first from the definition that what is monetary policy. What is monetary policy? So monetary policy is actually the action taken by the central bank. If you take the example of Pakistan, so the central bank of Pakistan is the state bank of Pakistan, and the central bank of Pakistan, they take actions, and these actions are taken to influence what the supply of money and the credit, okay, and the economy. And what is the purpose, why they are doing this? Because to achieve the economics or objective, the economics goals. And the economic objectives is, number one is the low inflation. The government want the country have low inflation. They want stabilize the economic growth. And the third one, they want low unemployment. They just want to reduce the level of unemployment and want to increase the level of employment. Clear? So in the definition we have discussed, we have clear with the two things. The first thing is that these action, the action, the monetary policy is actually referred to the action taken by the central banks, which is the State Bank of Pakistan. And why they are taking these action, they want to influence the supply of money and credit in the economy. And why they want to influence the supply of money and credit? Because they want to achieve the economics goals, they want to achieve the economic objective. And what is the economic objective? So the economic objective is low inflation, stable economic growth, and the third one is low unemployment. Clear? Now let's talk about the history. If we at the origin, if you discuss from ancient civilization time, so the origin of the monetary policy can be traced back to the ancient civilization, okay, where the government regulate the government. What the government doing? The government was just regulating. Where is, okay, here, government is to regulate what they want to regulate: the supply of money, and the second is the credit. Why they want to regulate the supply of money and credit? Because they want to what? To promote economic stability. And the second thing, they want growth, economic growth. So for that purpose, in the ancient times, the monetary policy was just used to regulate, the government using the monetary policy to regulate the supply of money and credit. And why they are doing this? Because they want to stability in the economics, they want economic stability. The second thing, they want growth, economic growth. Now if we think from the modern perspective, then the modern concept of the monetary policy is is as a tool for the central banks. The monetary policy is the central bank using the monetary policy is a tool, and the tool is for the purpose to regulate the supply of money supply. They just want to regulate money supply. And the second, then they just want it to regulate the interest rate. For these two purposes, the central bank use the monetary policy as a tool to regulate the money supply and the interest rate. Now, if we trace back this to the late 19th century and early 20th centuries, when the central bank were established in many countries, like if you think, if you just take the example that the Bank of England, which has been established in 1694, and the Federal Reserve Federal Reserve System, which is in USA, that has been established in 1913. Now let's talk about the tools which are used by the central banks to achieve the monetary policy objective. And we have already discussed what is the monetary policy objective. The first one is low inflation. Second one is stable growth. Reduce the low unemployment, reduce the unemployment, and also to reduce the supply of the money. These all are the objective, the economic objective, which the central bank want to achieve through the monetary policy. Now, setting interest rate. Central bank use a variety of tools to achieve their monetary policy objective. Which include the setting the interest rate. Now, first we have to understand what is interest rate. Interest rate refer to the price of borrowing money. Let's say if you're taking money from the financial institution, then you have to pay some money. You have to pay for that. That was called borrowing cost, and that borrowing cost is the interest. So the price of borrowing money, or the yield for saving money at a financial institution, then we call that as a interest rate. Now, by increasing and decreasing interest rate, central bank can influence the borrowing cost and spending in the economy. How? If we increase the interest rate, if you see here, if we increase here, if we increase the interest rate, then our borrowing cost will also increase, because we have to pay more money for the loan we are taking. And for that purpose, if our borrowing cost is increasing, then we will reduce the borrowing. We will reduce the borrowing, and definitely the spending in the economy will be reduced, and also the money supply will also reduce because of the borrowing cost. Now, the second tools which is used by the central bank for achieving the monetary policy objective is the open market operation. First, we have to understand what does market mean. Market mean where the buyer and the seller buying and purchasing. Then we call that market. But what is open market? Open market, we refer to the market where the government, where the goods and services and financial asset are bought and sold freely without any restriction. There is no hurdle for. And the second thing is, in the price of the product, the price of the goods and service and financial asset is determined by the supply and demand of that particular product. So means there is no intervention, there is no government intervention. The market is completely open, and the price of the product is determined by the supply and demand in the market operate in the competitive environment. Clear? If you I just give you the example. Before the dollar was just on 230, okay, but in open market the dollar was just selling and buying at 270, something like that. So there was some when the IMF told the government that you have to trade the dollar in the open market. So when the dollar start trading in the open market and it goes up, the rate of the dollar goes up, and the reason behind that is because the price of the dollar was determined by the supply and demand of that dollar. Now we have another perspective that we'll discuss, that open market operation. Okay, first we have to understand what is open market. So open market is the market where the goods and services and financial assets are bought and sold freely, and the price of the goods and services financial asset determined by the supply and demand of the goods, services and financial asset. Mean there is no restriction. Okay, there is no restriction, and the market operate in a competitive environment. Let's talk about what is open market operation, because we already discussed that the tool which are using for the achieving the monetary policy objective is open market operation. So we have discussed the market concept, then open market concept, and let's talk the ultimate objective of that is open market operation. What is open market operation means? So open market operation refers to the buying or selling of the government securities, like treasury bonds, treasury notes, treasury bills, treasury inflation protected security, which called TAPS, municipal funds by the central bank, such as if you think about for Pakistan, then there is Central Bank of Pakistan is a means of influencing the money supply and interest rate in the economy. So when the central bank is purchasing and selling the government security in the open market operation, and the purpose is to influence the money supply and interest rate, and how they influence the money supply interest, we'll discuss this. Okay, don't worry. Okay, the first thing is when the central bank, for example State Bank of Pakistan, buy government security, then it increase the money supply and lower interest rate by making more fund available to bank. Okay, and for this they stimulate the economic activity and encourage spending and investment. Clear? So when the State Bank purchase government security, so this will increase the level of money supply and reducing the interest rate. How they reduce the interest rate? By making more fund available to the bank, and this will stimulate the economic growth and also encourage spending and investment. Clear? And now if when the government when the central bank sell the government security, so this will reduce the money supply, and when the money supply reduce, okay, so the spending will also reduce in the economy. The second thing, and raises interest rate. How they raise the interest rate? By removing the fund from the banking system. So when they are removing the fund, they are just when they just remove the fund from the economy, then definitely the interest rate will goes up, and the money supply will also reduce, and so this will the impact of this thing will be slow down the economic growth, and inflation will also reduce and also come in control. Now the third tool which the government when the central bank is using to achieve the monetary policy objective, and that is called reserve requirement. And we know that what is reserve. Okay, what is reserve? So when the central bank can also change the amount of reserve that bank are required to hold, which affect the amount of money bank have available to lend to borrower. So this means that when the commercial, first we have to understand what is reserve. Commercial bank are required to hold some amount, okay, and this amount is a reserve, and this amount is set by the central bank, like say State Bank of Pakistan, and the commercial bank don't have to use that money. Clear? Now if the central bank change the reserve requirement, then this will affect the money supply and interest rate. And I have given here example. If you see here, let me write from here. Okay. Let's say before the central bank said to the commercial bank that you have to hold, let's say 100 reserve, okay, and this bank have the total amount of $500. Clear? Now the central bank said that you have to hold 200 reserve. Okay, mean this reserve has been changed from 100 to 200, mean it's increases. So the bank have 500 now, and the 100 is for the reserve and the 400 for spending, right? And this 200 for reserve and the 300 for spending. So when the government, now when the central bank increase the reserve requirement increase, let's say from 100 to 200, so what the money supply will be reduced. You know, the money before, the money supply was 100 and now it become 300, so to 400, and it become reduced. So what does it mean? It means that when the central bank increase the reserve requirement, so the bank will have less money to spend, and this less money, they have less money to lend to the consumer, to the businesses, and this will help to reduce the money. This will reduce the supply of money in the economy, and if the money supply reduces in the economy, then definitely then economic activities will also be reduced, and for this purpose the inflation will also reduce. Now if we take the other side of the coin, then we will say if the reserve, the required reserve is reduced, so the bank will have more money to lend, and definitely this will boost the economy. The economy will be overheating, and the economic activity will also increase, and this will also affect the inflation, mean the inflation also goes up. So this is the case. Now for when we are controlling the money supply, then we have to the central bank have to increase the reserve requirement. Now the second thing, if we want to influence the interest, if the central bank want to influence the interest rate, then how they influence the interest rate? Okay, now when the reserve requirement is increased, so more expensive for the bank to hold the required reserve, which lead to the high interest rate, and vice versa. And when the reserve requirement increase, so bank pays a higher cost of holding the required reserve, which leads to higher interest rate and reduction in the money supply. So bank must hold a larger portion of their deposit in reserve, which means they have less money available to lend, to borrow. So this reduction in available fund can increase the cost of borrowing for consumer and businesses, as bank may need to charge high interest rate to maintain their profit margin. So this will influence the interest rate, mean the interest will goes up when the reserve requirement is high, and the interest rate will reduce when the reserve requirement is reduced. So when they decrease the reserve requirement, so definitely interest rate will also be reduced, and more money will be available in the market, in the economy, and spending will also increase like that. Now the third thing is reserve requirement is also helpful to ensure that the bank have necessary fund that meets the demand of the depositor and respond to change in the market condition. And the last, the four tools which the government the central bank are using to achieve their monetary policy objective is the discount window lending, and this is actually a facilities. And this facility, the central bank can provide loan to the banks, commercial banks, in the form of discount window lending, and which can help to ease the liquidity constraint and provide support to the banking system in a time of stress. So when central bank want the tighten monetary policy and want to reduce the the money supply, then central bank raise the interest rate at charge for discount window loan. So the charge when if the central bank increase the interest rate which they are charging from the discount window lending, then it will be very costly for the bank to take loan from the central bank, and definitely they will reduce their borrowing level, and this will also if they reduce the borrowing level, then less the money supply will also reduce, inflation will also control by this way. And if the central bank want a loose policy, loose monetary policy, and want to supply to increase this money supply, then they will reduce the interest rate on the down window lending, and this will that will be cheap for the bank to take loan from the central bank, and this will increase the money supply, plus also it will also increase the inflation. So we have discussed that it's expensive for the bank to borrow from the discount window and encourage them to seek fund from the other sources when the interest rate goes up on the down discount window lending, and this will reduce the amount of money in the economy and help to reduce the inflation. Now, if the other side, we have already discussed that at the central bank, the central bank wants a losing monetary policy, and they just want to increase the supply of money. Then they reduce the interest rate at charge for their discount window loans. So this make it cheaper for the bank to borrow from the central bank and encourage them to lend more to consumer and businesses, and this increase the amount of money in the economy, and it will help to stimulate the economic growth, because spending will increase and definitely the growth will also increase. Now we have two main types of monetary policy. The first one is expansionary monetary policy, and the second one is contractionary monetary policy. If we discuss the first expansionary monetary policy, so is the expansionary monetary policy is designed to stimulate economic growth and to increase the money supply, right? So this type of monetary policy is often used to fight recession and boost employment. Okay, if the government want to increase the employment level, then definitely they will implement this policy. Okay, in a time of recession, they also use this policy. Now, what are the tools which are used? The first one is central bank may use different type of tools, such as lowering interest rate, buying government security, we have discussed this, through open market operation, and reducing reserve requirement, we have also discussed this, to increase the money supply and stimulate borrowing. Now the second policy is contractional monetary policy, and this policy is designed to gob the inflation, to control the inflation, and to reduce the money supply. So this type of monetary policy is used to slow down overheating economy, and to control inflationary pressures. And central banks may use tools such as raising interest rate, selling government security through open market operation, and also increasing reserve requirement to reduce the money supply, and to control the borrowing. And the last, we have to discuss that when the election is near, and the lead of election, when the election is just near, then what type of policy the government usually adopt? So government may be more likely to adopt expansionary economic policy, and the reason is that the government just want to increase the government spending. They just reduce or cutting the taxes. They just reduce the interest rate. They make effort to boost the growth. They also want to create a positive economic environment, and due to this, they will get a capital, political capital. You can say voting bank. They will get more vote from the public if they implement a policy which is friendly to the public. So this is all about the monetary policy we have discussed in a very detail. I hope you people understand this. Thank you.